Hi, I'm Joe Slavens, President and CEO of Northwest Bank and Trust Company, and it's my pleasure to welcome you to our 2021 Investment and Tax Outlook Program, being done a little differently this year as a result of, wow, what a crazy year 2020 was. And I guess at this point, I'm trying to be polite by the choice of my adjective there. You know, what's really amazing to me is how much change we went through over the last year, and yet you can be assured that Northwest Bank and Trust Company is just as strong today as it has been over the years. Incredibly, through the work of our great team, we actually achieved our budget in this, again, very, very difficult environment. So how did we do that? Again, I think it's important we did it by serving our community. What I'm maybe most proud of is the fact that we, relative to our size, delivered 6 times more what they call PPP, or Paycheck Protection Program loans, than any of our competitors in the Quad Cities, saving and assisting 6 times the number of businesses and making sure that we maintain 6 times the number of jobs that, again, our local competitors did. The other thing that I'm incredibly proud of and really looking forward to having an impact on Northwest Bank and Trust Company is bringing together several small accounting firms. We had Blair Westfall, and now we've had Jeannie Pyle-Scott and her team, and you'll learn more about her in a short time period. We now have named that organization Centennial Tax. And we're very proud of the fact that we'll be able to expand our services to you, expand the level of expertise that we have. You know, we've been in the investment management business now for 51 years. I'm even more proud, however, of the fact that Northwest Bank and Trust Company will celebrate its 80th anniversary of being in business here in the Quad Cities in July of 2021. And you know, you start to ask the question, why does an organization continue to thrive and succeed and be able to deliver great services? It's really a testament to the fact that we have a great team. You know, we are large enough to have the expertise that you need, but we remain small enough to build the relationships that are essential to you sleeping well at night. And with that, the other anniversary that I'm very proud of is the fact that Cody Allen, who you will hear from next, will celebrate his 15th anniversary with Northwest Bank and Trust Company on August 15th of this year. Cody has risen to being Senior Vice President and Senior Trust Officer here at Northwest Bank and Trust Company. Very proud of Cody and the entire team that he's built and the work that he does for you. And so with that, I'd like to turn the program over to Cody.
Thanks, Joe. Hi, my name is Cody Allen. I'm Senior Trust Officer and Senior Vice President of Northwest Bank's Investment Management Group. I have the honor of introducing our 2 speakers today. Before I do, I want to take just a moment to voice our appreciation for the amount of referrals we received from you, our clients, and to our investment management group in 2020. We were truly honored to welcome the friends and family members you sent to us. We don't take that responsibility lightly. New clients entrust us with their investment assets, their estate planning needs, and we were very honored to welcome that new business in the door. In fact, it totaled a little bit over $50 million in new assets in 2020, a responsibility we do not take lightly. Please continue to spread the word for us. If you have a friend, a family member that might find value in the services that you receive from us today, please let us know. And if you're not a client and you find value in what the speakers have to tell you today, please give us a call. We'd be more than happy to speak with you and determine if we would be a good fit and we can add some value to your financial situation. So without further ado, I'm going to go ahead and introduce our 2 speakers. Our first speaker is Keith Bonjour. Keith is our Vice President and Portfolio Manager at Northwest Bank. Is a certified financial planner and has over 16 years of experience in the financial industry. His primary responsibilities are managing the investment research and portfolio construction for the investment management group, as well as providing financial advice to our clients. Keith graduated with honors from Ashford University and enjoys continuing his education. Keith, every quarter, is attending a number of webinars and seminars and stays very in tune to what's going on in the investment world. Our second speaker will focus on the tax side of the program, and that is Jeannie Pyle-Scott. Jeannie Pyle-Scott has been working in the accounting industry since graduating from Truman State with a master's degree in accounting in 2002. Jeannie is a member of the American Institute of Certified Public Accountants, the Iowa Society of Certified Public Accountants, and the Institute of Certified Bankers. She spent much of her career in the private trust company and family office, serving high net worth individuals and families. In 2015, she purchased an established CPA firm founded over 30 years ago by Jim Schnorr. And at that point in time, Pyle-Scott and Associates. In 2020, she merged the Pyle-Scott office into the Blair Westfall office, to form Northwest Bank's Centennial Tax and Accounting Division and assume the role of Vice President and Director of Tax and Accounting. Those will be our two speakers today. I'm going to turn it over to Keith, and then he will turn it over to Jeannie. I hope everybody has a great and healthy 2021, and thank you for your time.
Hello, everyone, and thanks for joining us for our 2021 investment outlook. There's been a lot to talk about today, so I'll dive into some of the information. But first, I just wanted to recap what we saw last year, 2020, in the wild year that it was. So you can see the title slide, a truly wild ride. If we take a look at the returns by different asset classes last year, first starting with municipal bonds performing about 4.6% for the year. We saw investment grade bonds up 7.4% for the indexes for the year. TIPS were up 9.7%, the best performer out of fixed income. High yield bonds at 5.1%, and then emerging market debt was actually slightly negative for the year. But overall, bonds had a really strong returns in 2020. And then also looking at the equities, you can see the U.S. market, U.S. stocks almost 16% positive for the year. Developed international stocks were trailing. They were positive, but only 3.7% for the year. And then emerging markets had a pretty strong year, up 10.6%. On the real asset side, we saw natural resources were down a little over 6%, global real estate down 11%, global infrastructure down about 8.5% on the indexes. So the real assets were really the biggest underperformers last year, with both stocks and bonds outperforming expectations for the year, especially after the COVID sell-off, with the market S&P hitting down almost 35% in the February and March timeframe before staging a massive rally to end the year in positive territory. So it truly was a wild ride last year in 2020. Looking forward, we take a look back at 2019 and 2020 on the next slide, with what we've seen in GDP growth, and then the expectations of what we see going forward in 2021. So you can see 2019 in the green bar, the US GDP was up 2.2% for the year. In the Eurozone, up 1.3%. Barely positive in Japan at 0.7%. China having a decent year at 6.1% in 2019, which was actually slower than they had been growing at. And if we look at 2020, what the effects of COVID has had on global GDP, the U.S. finishing the year down 3.7%, the Eurozone down 7.6%, Japan down 5.4%, and then China holding up the best, up right about 2% for the year. And now if we look at the returns for 2021 from a GDP growth percentage perspective, the U.S. is expected to grow at 4%. I've seen some projections even up to 5 and 6% for U.S. growth, but right now Northern's outlook is a 4% on 2021 growth, GDP growth for the U.S. The Eurozone growing at 4.8%, Japan at 2.6%, and then China resuming strong growth at over 8%. So something we're going to be watching very carefully as we go throughout the year, with the first half of 2021 expected to be more choppy as COVID cases continue to climb, and as we wait for vaccines production to ramp up in a large way. So hopefully by the second half of the year, things will start to normalize, and expectations are that we see strong growth in GDP in the second half of the year, increased consumer spending, and better company earnings in the second half of 2021. So those are the expectations going into the year. We'll be watching that very closely for how that plays out. Inflation has also been extremely muted, so we'll be watching to see if there's signs of increasing inflation, which is expected this year. The Fed has said that they will be willing to let inflation, run above that 2% mandate, but how high that can go before the Fed does feel the need to start raising rates is yet to be determined. At this point, they don't think it's going to go high enough where they'll need to start raising rates until at least the end of 2022, if not, several years forward from that. So again, we'll be watching that with a close eye as this year progresses. As we go into the next slide, we can see that inflation has been stuck below target, not only in the U.S., but in Europe and Japan for a number of years. This chart goes back to October of 2017. The target for inflation, especially in the U.S., around 2%. They did get above that back in 2018, and inflation has slowly been coming down since then. When today's around 1.4% today, with expectations that we will get back up above 2% this year for the first time in the last couple years. Like I said, the Fed is going to let inflation run hotter as the economy is in a recovery mode before they do start hiking interest rates. And then expectations are we do start to see an increase of inflation, but it doesn't stick around long, and eventually we settle back down around that 2% target inflation. So something we will keep a close eye on as this year and next year progresses. But as of right now, expectations are that inflation will rise, but it won't rise enough that it becomes a problem for the economy going forward. The next slide, we talk a little bit more about monetary policy with fiscal policy. So these are government deficit forecast as a percent of GDP. You can see in 2020, the big hit to GDP percentage wise in the US of over 18, almost 19% for the year. We do think that the government deficit forecast in 2023, things are going to start to look a little bit better at that time, still running a deficit, but not nearly as bad as what we were in 2020. The same holds true in both the Eurozone and Japan. You can see the big losses last year that they had for running larger government deficit forecasts, both of those improving in by 2023. And then if you take a look at China, China is not looking like they're going to improve their government deficit forecast too much from 2020 to 2023. A little bit better position, but again, a lot higher than the other developed nations in the US, Eurozone, and Japan. So we do think that the US can continue to service the debt, especially when interest rates are as low as they are in today's terms. It's pretty cheap for the U.S. to continue to service that debt when interest rates are at rock bottom levels. If rates do start to creep up in the future, that's when then debt servicing becomes a bigger issue and starts to weigh more on the U.S. economy and Eurozone and Japan. But at this point, we still think that's several years off before those figures will have to be tackled in a more meaningful way. As we look at the flows for the year, I thought this chart was interesting to share with everyone. The red line here, this is from the March 23rd of 2020 timeframe. You can see in the red line, that's fixed income or bond inflows for the year. Bonds saw pretty steady inflows all throughout the year and actually had larger inflows into the bond market than what we saw the stock market. After the lows of March 23rd, you can see there was some inflows into stocks, and then things tapered off and actually pulled back after that time. And then they slowly started to accelerate through the summer months. Right once we got through elections, though, you can see a massive amount of money did flow into the stock market. One of the reasons that the Q4 of 2020 was so strong for stocks is that we did see a lot of new money, especially right after the elections, flow into the stock market, looking at probabilities of additional stimulus coming into the market when Biden took over the presidency, as well as possible infrastructure packages being passed by the U.S. government this year, both of which would be very stimulant to the market overall. And then also with Biden taking over the presidency, since there wasn't a large blue wave, it's less probable that we'll see as much in the tax hikes that the market was fearing there. So that can is probably getting kicked till at least 2022, letting the economy recover before we start to see some tax increases. So at least for 2021, we don't think taxes will rise meaningfully on the corporate side. We don't think the Biden administration will do much on the estate tax side either, or capital gain rates. So this year that those risks should be pushed out another year. So we will be watching that as we go forward as well. But at this point, additional fiscal stimulus as well as a very accommodative Fed and then a possible infrastructure bill, all of those are nice tailwinds for the market in 2021. And then taking a look at the longer term view, this is a nice chart that shows some previous bull market cycles. You can also see when the markets have stagnated. Now, we talked about this chart last year as well, but if we look back from 1929 to 1942, you can see a big boom in the market followed by the crash during the Great Depression. But over that 13-year span, a lot of volatility for the market to basically end sideways. And then after 1942, the market resumed a nice bull market trend all the way until 1969. From 1969 until 1982, again, going through about a 13-year period of stagnation, a lot of volatility to go nowhere over that 13-year span. And then another bull market starting and the market ramping up nicely from 1982 all the way to around 2000, 2001. And then, of course, from 2001 through 2013, a lot of volatility, two big recessions that the market went through over that period of time. So there weren't any big gains through that period as well. So the question is a new bull market started in 2013, and how long would that last in that period? So the next chart is going to show a little bit more details on comparing the current bull market, if it did start in 2013 and has continued, of what that looks like, versus the last large bull markets that we saw in the 1950s and in the 1980s. Both of those had a deep correction in year 8, just like what we saw in this current bull market cycle. So if you follow the charts, the current cycle that we're in right now is going to be the blue line. You can follow along from 2013 until where we're at in today's dollar starting in 2021. You can see the large correction that we went through in February and March of last year, and then the recovery coming from that. If we take a look a little further back, this was the bull market of the 1950s there in the gray line. You can see that tracking pretty closely with the current bull market that we're in right now. It was slightly ahead in 18 and 19. Saw a similar correction on a time frame before continuing that bull market trend. You know, you can see some volatility along the way, a couple more pullbacks years later, still ending on a positive slope over that bull market cycle. And then the next one to compare it to is in the 1980s. We saw very similar returns in the 1980s as where we're at today, with the big bull market run up. Again, a pullback in year 8 of that bull market cycle, and then rebounding nicely throughout that period. There always is some volatility and some pullbacks along the way, but all inside of a bull market cycle. So, you know, they say history doesn't repeat, but it does tend to rhyme. We're not saying that the S&P 500 is going to end up in year 2026 at 58 or 5,900, but if it did follow those cycles that we saw in the 50s and 80s, that would be a rough target price if it continues to follow those charts. So just a little food for thought on previous bull market cycles as they compare to the market rally that we've seen today. The next chart I wanted to look at is 2020 estimated earnings per share growth by sector. This was really interesting last year of how each individual sector performed in the market. So the blue lines are expectations as of January 1st, where the market thought growth was going to be. And then the red lines are where the earnings per share growth actually ended the year, or actually was as of December 1st when this chart was published. So what really stands out here is you can see healthcare, technology, and consumer staples and utilities being slightly positive. But the biggest growth came out of healthcare and technology, up 7 and 6% respectively for the year. The only ones that were showing meaningful earnings per share growth for 2020. If we take a look at some of the other sectors, overall, the S&P earnings per share growth was down 15.5%. Financial earnings per share growth down over 24%. Consumer discretionary down over 34%. Industrials down 54.5%. And energy just massively down, up over 108 or down over 108%. So something that we've been watching, one of the reasons that the index has held up so well is the big representation in technology stocks, also with healthcare, and those names holding up so well, with technology making up about 25% of the S&P 500, the top 5 names in there. So when you look at some of the other areas that got hit as very, very hard, they were not nearly as big a percentage in the S&P 500 last year. So big discrepancy between the strong performing stocks and then the underperforming sectors last year. So we're going to be watching that very closely. Growth has continued to, the growth sectors in healthcare and technology have continued to outperform versus their value counterparts for quite a while now, well over 12 years. So watching that very closely, if we start to see a rebound in those value names and in energy, industrials, and financials, especially in 2021, we started to see that in Q4 of 2020. I'll be watching closely to see if that continues in 2021, that rotation. So the next chart I wanted to talk a little bit about was U.S. equity returns by party control. So the first chart, or actually all the charts, are going to show Republicans in red, Democrats in blue, but the first chart just shows the executive leadership, regardless of who had control of Congress. So this chart goes all the way back to 1946 through the end of 2020. You can see here when Republicans held the presidency, the S&P 500 was averaging about 7.1% per year over that span. When Democrats held the presidency, regardless of Congress, the S&P averaged about 10.5% over that period of time, going back to 1946. Now, when each party had full Congress support, the presidency and the full Congress support, you can see Republicans perform the best with full Republican support at 15.7% a year. When it was a full Democratic support with the presidency and holding Congress, 8.8% a year. When there was a split government with a Republican president, Congress was split. The average was 5.2% a year. And when there was a Democratic president with a split Congress, it's averaged 13.1% per year. So if we look at where we're at in today, we do have probably full Democratic support, but a very, very thin majority with the vice president breaking the tiebreaker in the Senate. So I would say we fall more in line with this chart here, but you could argue very close to split as well. So not trying to make any predictions of where things go there, just looking historically of returns in the market based on party control. So the next slide I wanted to take a look at comes down to risk. Really interesting to look back at inflation and interest rates being as low as they are today. If we went back to 2000 and investors said that they needed to earn an expected rate of return of 6.5% a year, well, at that point, you could buy all investment grade bonds and earn a return of about 6.5% a year for an expected return. The standard deviation or the risk on that portfolio at 3.7%. So again, very low risk in order to earn that 6.5% rate of return. Now, if we fast forward 10 years to 2010, to earn that same 6.5% rate of return, you would have had to put 25% in investment grade bonds. The other 75% would have went into U.S. equities to earn that same 6.5% rate of return. But if you look at the risk goes up almost 4 times to earn that same level of return at 6.5%. So as interest rates have become lower, bond returns, the coupon that bonds are paying has come down, and you've had to add more equity exposure into the portfolio in order to earn that 6.5% rate of return. Now, if we fast forward to 2021, you can see portfolios have to become much more diversified, much more complicated in order to get that same expected return at 6.5%. And the standard deviation of the risk comes up a little bit as well. So this is a combination of 40% in U.S. stocks, 21% in international, 8% in emerging markets, 7% in high yield. And then you can take a look at some of the other areas such as natural resources, global real estate, listed infrastructure, hedge funds, private equity, all those different asset classes in there to try to get that same 6.5% rate of return. So not trying to scare folks, but just pointing out that investing has become a little bit more complex over the last 20 years in order to earn those same expected returns that an all 100% investment grade bond portfolio could have done back in 2000. So just shows the importance of having a well-diversified portfolio, making sure that you manage your risks in order to try to target those same specific returns in today's dollars. So the next piece, I couldn't do a presentation without talking about COVID-19 and the vaccine rollout that we're seeing right now. So this is a great chart that the Guggenheim put out talking about how do we bring down the death rate from fatalities from COVID-19. And if we take a look at the left-hand side of the chart, this is the reduction percentage in fatality rates as more and more people become vaccinated. And the bottom axis, we're talking about the percent of population that becomes vaccinated. So what Guggenheim found was from their research that they're publishing here that if we were able to vaccinate those age 65 and older, making up 17% of the overall population, that would cut the fatality risk by over 75%. So what you're seeing right now is a push to get vaccine producers ramping up as fast as possible, going out vaccinating those individuals in nursing homes and most high-risk individuals there. You can see if we only vaccinated the folks that were 85 and older, that would reduce the fatality risk by 35%, those aged 75 and older by over 55%, And then that 17% of the population that's 65 and older, if they were all to be vaccinated, that would reduce the fatality risk by over 75%. So pretty interesting. And that's why government officials are working so hard to ramp up the vaccine production and really target not only the first responders, but those most at risk of fatality from COVID-19. So we're hoping that production continues to ramp up and we see even more vaccines approved in the first half of 2021 to help with those production issues as well. The next chart here talks a little bit more about what we would need to do to build up the herd immunity. There's been talk that it could be achievable by the early summer months. We know we need to ramp up vaccine production and get more vaccines out to folks as quickly as possible. But the chart on the left-hand side shows those folks that have already or will get the virus and have immunity to it for a period of several months, plus adding on the purple chart or the purple graph that's showing those that will have immunity from the vaccine. And you can see by the early summer months in the June, July timeframe, crossing over that red line that should prove to be herd immunity from the vaccine. If that was to happen, hopefully things will get back to a little bit more of a normalcy in the late summer months and early fall. Really help folks get out spending money again, help company earnings, and help drive the stock market as well. So something we'll be watching closely to see how that plays out. The chart on the right shows projected and actual daily vaccinations. The daily vaccination goal, you can see we were running below that of what the actual folks vaccinated was. But since January, you can see a big pickup in vaccination rates. So those have actually been coming up and ahead of goal. The problem now is some of the vaccine producers are running behind on their production numbers. So needing to ramp that up in order to get more shots to more folks that are especially those that are high risk. So as long as those vaccination producers can continue to ramp up production and meet those goals, we're hoping to see strong production by the summer months and hopefully get to that herd immunity in the summer. So something, again, we think is going to be a big driver for the economy this year. The next chart I want to spend a little bit of time on is more about diversification and the case for diversification. This is called a quilt chart. It looks at a lot of the major asset classes on a year-by-year basis going back to 2010. And then it aggregates it over the last 10 years. So if we take a look on the right-hand side, the 10-year aggregated numbers, you can see the U.S. equities have performed the best, up over 14% per year over the last 10 years. The surprising one, a 60-40 portfolio, so 60% in the MSCI World Stock Index, 40% in the Barclays Ag, you would have actually earned 7.6% per year over the last 10 years. And actually had the second best performance of all the asset classes. If you would have put your money all in high yield bonds, you would have averaged 6.8% a year. All in global real estate, a little over 6.5% per year. Right at 6.5% per year in infrastructure, 5.7% per year in developed international stocks, followed by municipal bonds at 4.6%, emerging market stocks at 4%, investment grade bonds at 3.8%, TIPS at 3.8%, gold's averaged 2.9% a year over the last 10 years, followed by global fixed income, emerging market fixed income, natural resources, and cash. But the road to get there, if you follow any one asset class, you'll see it bounce around up and down and all over the board here. But if we take a look at the charts that are in black, you will see that 60-40 portfolio having a nice diversified portfolio, 60% in the stock market, 40% in bonds. You're never going to be the very best, but it's never the very worst, and it smooths out the ride over that period of time. And at the end of that 10-year span, actually ended up to be the second best performer out of all the different asset classes tracked on here. So not saying everyone needs to be invested in a 60-40 portfolio, just pointing out the case for diversification, that it doesn't seem to work every year, but over long periods of time, it smooths out the volatility and does give consistent returns over time. The next chart, a little bit more on diversification. So if we take a look at the top chart, this is going to be portfolio returns of different portfolios, either all equities. The first one is going to be 40% stocks, 60% in bonds. The next one is going to be 60% stocks, 40% in bonds. And then the green chart shows if you were all in the S&P 500. Now this tracks if you had 100,000 in the S&P 500 as of February 9th of 20 or February 19th of 2020, I'm sorry, and going through the downturn. So you can see the all stock portfolio gets hit much harder. The one that has more in bonds, that has 60% in bonds, 40% in stocks, holds up much better. The one with 60% stocks, 40% bonds, pretty much in the middle of those two, holding up a little bit better as well. And then you can see how long it takes them to recover. So the most conservative portfolio with only 40% stocks, 60% bonds recovers first on June 8th of 2020. The portfolio that was 60% stocks, 40% bonds fully recovered on July 20th. And being all stocks in the S&P 500 took you to August 10th to fully recover from those losses. Now, the more aggressive investor that was all stocks ended the year at a higher level, but they had to deal with a lot more volatility on the way to end at those levels. So just another good illustration that diversification, for those that can't handle the volatility of 100% in the stock market, diversification does really pay off to protect better on the downside, help you get back to even quicker when the market does rebound. And then the bottom chart, I thought this was very interesting to take a look at. It's 20-year annualized returns by different asset classes, again, from 1999 through the end of 2019. Over that 20-year span, REITs, real estate, was actually the best performer, up 11.6% per year over that period of time, followed by high yield bonds, up 7.9% per year. Small cap US stocks averaging 7.6% a year. Emerging market stocks averaging right at 7%. The top 500 US stocks, so this is the S&P 500, averaged just over 6% a year. If you remember in the chart we looked at previously, it was the best performer over the last 10 years, but from 2000 and 2010, the S&P actually averaged a slightly negative return over that full decade. So weighing down the 20-year average. If you would have been 60% in stocks, 40% in bonds, you would have averaged right about 5.6% a year, given those indexes. 40-60, so 40% stocks, 60% bonds, slightly lower at 5.4% a year. All bonds about 5% a year. Developed market equities, 3.8% a year. Homes, so this is a real estate, an actual residential homes, averaging 3.4% appreciation over that period of time. And the most interesting one, these are flows tracking all individual investors by their investments out there. And the individual investors that were not working with a professional, you can see by fund flows, they only average 2.5% a year. And the reason being is the average investor tends to make some of those decisions at the wrong time. So when the market is selling off, like we saw back in February and March, choosing to get out at the wrong time and sell near the bottom, and then waiting too long to get back in after the rebound and missing a lot of the upside. So the average investor making emotional decisions and getting out of the market at the wrong time and getting back in too late really hurt their returns over time, actually underperforming what we've seen out of an all bond investor if they would have just bought all bonds and left the portfolio alone over that 20 years. So the average investor was barely outpacing inflation of 2.2% over that 20-year span. Cash rates averaging about 1.7%, commodities being the worst performer over the last 20 years, right at 1%. So interesting to take a look at by different asset classes. And again, a reminder that the S&P was the best performer over the last 10 years. If we look over the last 20 years, though, it doesn't have nearly as strong of returns because of 2000 or 2010 when the S&P averaged about a negative 0.9% per year over that decade. And with that, I'll conclude my presentation today. If any of you do have any questions or want to talk further about your portfolios this year, feel free to reach out to us. We do look forward to seeing you as part of your review meetings this year as well. And hopefully we can start doing these again face-to-face soon. Thank you all for tuning in today, and we appreciate your time.
Thank you to Cody and Keith for inviting me to take part in your presentation. I'd like to speak to you all today a little bit about some important tax topics for 2021, as well as what changes we might see on the horizon with the new administration taking office. We're approaching the filing season for your 2020 tax returns, so we'll start with that. The IRS announced recently that the filing season would not open until February 12th for individual filers, meaning that any refunds for those early filers likely would not start hitting bank accounts until late February or early March. At this time, the IRS is not planning to extend the filing tax deadlines for 2020 returns. Of course, we learned with the global pandemic in 2020, anything is possible, but unless and until we hear differently, you should plan to file your returns prior to the April 15th deadline for individual filers. As a result of COVID, there were far more people eligible for and receiving unemployment than in most years, so I do want to touch briefly on this subject. It's important to remember that unemployment compensation, including that extra $300 to $600 per week authorized by the federal government, is taxable income. And if applicable, you will receive a Form 1099-G reporting the amount of unemployment benefits received. You want to keep in mind also that even if you elected for tax withholding from your unemployment compensation, that in both Iowa and Illinois, the federal tax withholding rate is a flat 10%, which is less than the effective tax rate for most taxpayers. So don't be surprised if you still owe additional taxes as a result on this income. For 2020, the standard deduction is $12,400 for single filers and $24,800 for couples. These amounts are increased by $1,300 for each individual who was 65 or older in 2020. Keep in mind that while the higher standard deductions we've had in place for a couple of years now preclude a lot of taxpayers from itemizing on their federal returns, there might still be an advantage to itemizing on your state return. In our area, this is particularly true for our Iowa residents who can oftentimes benefit by itemizing deductions at the state level, even if they're claiming the standard deduction on their federal returns. Also for 2020, there is a new charitable contribution deduction allowable for individuals claiming the standard deduction. This is a maximum deduction of $300 for charitable contributions. This $300 maximum threshold applies both to single and married filers, though it's reduced to $150 for those individuals claiming the married filing separate status. When filing your taxes, it'll be important to know the amount of the two economic impact payments or stimulus payments you received. These stimulus payments are not taxable and your refund will not be reduced as a result of receiving them. However, they are required to determine eligibility for the recovery rebate credit. Taxpayers who receive the full amount of both stimulus payments are not eligible for the credit. However, if you receive less than the full amount in one or both rounds, you might be eligible for the recovery rebate credit and entitled to a larger refund. The intent behind the credit is to ensure that the taxpayers receive the full COVID relief funds due to them under the CARES Act and subsequent relief bill. The advance payments were based on either your 2018 or your 2019 tax returns, whatever was most recently on file with the IRS at the time of the payment. But your 2020 income is actually the final determining factor in what those payments should have been and what they will be, which is why we have the new recovery rebate credit. Taxpayers who might have received more than they were entitled to based on 2020 income are not required to repay the difference. But taxpayers who either did not receive the payments or who received less than they were entitled to because of their 2018 or their 2019 income, for instance, was higher than their 2020 income, will receive the balance due in the form of an increased refund. I won't spend a lot of time on the PPP topic as it relates to business and self-employed individuals, but I do want to mention a few key points. The CARES Act, which was signed into law on March 27, 2020, authorized a new program referred to as the Payroll Protection Program, or PPP. These loans were intended to help keep employees on the payroll and off of unemployment during the shutdowns and business disruptions resulting from the pandemic. The loans were guaranteed by the SBA and 100% forgivable for businesses that properly use the funds under the program guidelines. The CARES Act further stated that the loan forgiveness was not taxable, but the IRS spoke out against this and ruled that while the debt forgiveness would not be taxable, the expenses paid with loan proceeds would not be deductible, effectively turning what was intended as a tax-free boost for businesses suffering the effects of the pandemic into a taxable grant. Fortunately, in December of 2020, legislation was signed into law which addressed, among other things, the PPP program. The new legislation allowed for additional businesses and nonprofits to receive initial PPP funding if they had not already done so. It also provided for a second round of PPP forgivable loans to those companies most hurt by COVID. The legislation further clarified the intent in the CARES Act that the receipt of a PPP loan, which was later forgiven, would be a completely tax-free event by stating that the debt forgiveness would not be taxable and that the expenses paid with the PPP proceeds would be deductible. And lastly, in favor of the business owners as well, this legislation from December also stated that the PPP forgiveness would not be reduced by the amount of any tax-free EIDL grant received by a business. Under the original guidelines, the PPP forgiveness was reduced by the EIDL grant amounts, and these were the $1,000 per employee up to $10,000 per company grants that were received in the spring. I want to talk a little bit about your required minimum distributions from your IRAs or other tax deferred accounts. As of right now, Congress has not acted to extend the waiver of required minimum distributions, which was available to us in 2020. So please remember to take your 2021 RMD prior to December 31st, 2021, absent any future legislation on this matter, or you will be subject to substantial penalties equal to 50% of the distribution required. Some taxpayers, especially those who may not have taken their distribution in 2020, might be facing higher RMDs for 2021 due to higher account balances at year end. And lastly, just a consideration, if you pay quarterly tax estimates, you may want to consider asking your tax preparer to calculate these based on expected 2021 income and distributions, particularly if your 2020 income was lower than normal due to not taking an RMD, or you could end up next April with a tax bill that you're not expecting. Now I want to turn our focus to what's on the horizon for 2021 and beyond. With the new administration taking office and Democrats controlling both the House and the Senate, there are likely to be some tax changes on the horizon. It is too early to know what exactly these might look like or what changes might have enough support to pass, but we do know that some of the general themes that President Biden has discussed. With each new president, tax reform is at the forefront and can take the form of either repealing the changes passed by his predecessor or proposing new changes in support of his own agenda. With President Biden, we have heard some discussion about repealing all or a part of the wide sweeping tax reform passed by former President Trump in the Tax Cut and Jobs Act of 2017. But most of what we're hearing has to do with new changes that President Biden is proposing. What isn't as clear to us at this point is when these changes will take place if they're enacted. Most often, tax reform is forward-looking and becomes effective on the date of enactment or on a future date, such as January 1st of 2022. However, there are instances when changes have been made retroactively. So what we're left with when we're trying to decide what planning opportunities to take advantage of is deciding whether these are likely to be changes which will take effect in 2022, or perhaps later in the year in 2021, or whether these will be retroactive to encompass all of 2021. While retroactive enactment is a possibility, it's less likely, particularly with some of the proposed changes on the table. So if we're looking at the Biden tax plan, some of the likely changes proposed are as follows. It's also important to note that many of these tax increases will affect only the highest income earners and will have little impact on the average taxpayer. There are also a variety of expanded credits to help the middle-class taxpayers. The first proposal on the table is increased payroll taxes on higher earners. President Biden has proposed an increase to the Social Security taxes paid. Currently in 2021, Social Security taxes are paid on wages and self-employment earnings up to $142,800. After this point, the Social Security tax is eliminated for additional income earned in the year, regardless of the amount. The proposed tax increase would result in something very similar to the donut hole effect found in Medicare Part D coverage, but in this case, it would result in a tax holiday for the middle range. Under his proposal, Social Security tax would be paid on wages up to $142,800 as it is today. It would then cease and no tax would be incurred until wages reached $400,000. Upon reaching that $400,000 threshold, Social Security taxes would again be reinstated at the full rate on any income above this point. Another proposal from President Biden is to increase the top marginal tax bracket from 37% for individuals back up to the 39.6% that it was a few years ago. And one of the larger proposals, which has gained a lot of media attention, is the proposed increase to capital gains tax rates. The current capital gains tax rates start at 0%. Then they increase to 15% at approximately $40,000 of income or $80,000 for a couple. They increase again to 20% for those earning nearly $450,000 or $500,000 for a couple. This is still, even at the 20% rate, significantly less than it would be for ordinary income tax rates. Biden's tax plan would eliminate preferential capital gains tax treatments for those earning over $1 million, almost doubling the tax on capital gains for those taxpayers, but in actuality affecting very few of the average taxpayers in America. One of the other proposals is increased corporate tax rates. Biden has proposed increasing the corporate tax rates, which were lowered in 2018 under the Tax Cut and Jobs Act. It's unclear whether he will restore these to the previous levels of 35% or if it will be somewhere between the current 21% and 35%. We're also likely to see some Section 199A deduction modifications. The proposal here would modify the 20% QBI or qualified business income deduction for business owners, which was put in place to mimic the corporate tax cuts under the Tax Cut and Jobs Act. If we see the increased corporate tax rates we just discussed, we'll likely see some QBI modifications as well, especially for the higher earners. And then one of our other proposals I wanted to discuss was possibly reinstating the cap on the tax benefit realized from itemized deductions to 28% and restoring the 3% PEAS limitation as it relates to itemized deductions. Both of these limitations are the same ones that we had in effect for many years prior to 2018. We would just be reverting back to the old system under the Biden tax plan. The remaining proposed revisions are primarily aimed at reducing taxes for the middle class, though there are some benefits available to high income earners as well. The first of these proposals is to reinstate SALT, or state and local income tax. Biden's proposal would eliminate the $10,000 cap that we currently have on state and local income tax deduction, making it possible for a lot more taxpayers to return to itemizing deductions on their tax returns, keeping in mind that those itemizations might be limited somewhat by the cap that we just talked about on the tax benefit allowable. One of the other proposals is increasing the dependent care tax credit from $6,000 to $8,000 and expanding the Affordable Care Act premium tax credit for those on marketplace insurance. Another expansion of a credit that we currently have is the earned income tax credit. Biden is proposing to include wage earners over age 65 in this credit. Currently, those otherwise eligible for the credit who are under age 25 or over 65 do not qualify. He's looking at adding the seniors into that category and allowing them to take that credit going forward. Other credits on the horizon might be new renewable energy credits, a first-time homebuyer credit, whether that's the same that we've had in the past or if that's something new, the introduction of a renter's credit, and expanded retirement savings tax credits. The last group of reform has to do with the estate and gift tax and estate planning changes we might want to make, and I'll address that in just a little bit. But first, I want to stick with the income tax issues and look at some planning opportunities. Most of these planning opportunities we consider are going to focus primarily on bracket management. For example, if you believe you'll be in the new 39.6% tax bracket, you might want to look at possibly accelerating income into 2021 and having it taxed at only 37%, assuming no retroactive rate changes. Potential rate increases will also really drive Roth conversions. The three main considerations when looking at a Roth conversion are: one, bracket management. Can you achieve the conversion without significantly increasing your marginal tax bracket? Perhaps you do this by converting smaller amounts over a period of several years as opposed to one so that you can stay within your current tax bracket. The second consideration is, do you have outside money to pay the taxes? Or are you going to have to further deplete your IRA or tax deferred account to take distributions and then be taxed on those distributions to pay the taxes? And lastly, will you need the money after age 72? This last one is more of an estate planning consideration in terms of whether you'll be leaving tax-free or tax-deferred money to your heirs. With the Secure Act that passed in late 2019, we lost the ability to stretch inherited IRA distributions. That was eliminated, and now beneficiaries are required to withdraw all of the funds within 10 years of date of death of the account owner. For those inheriting tax deferred accounts, that can place a pretty big tax burden on them if they have to take out a sizable amount within a 10-year period. And that might make a Roth conversion more palatable to the current account owners who don't want to put that burden on their children or their grandchildren. While they would still be required to withdraw the funds within 10 years, if they did a Roth conversion, those funds would be withdrawn tax-free as opposed to be taxed to the beneficiaries. Another planning opportunity is capital gains harvesting, which is the exact opposite of what we normally think of. Again, capital gains harvesting would be an effort to achieve bracket management if you believe that you'll have over $1 million in income, where you would be subject to that higher capital gains tax rate. You might want to try to push those capital gains into the current year before that tax change might be enacted. On the opposite side of the spectrum, those trying to accelerate income would likely want to defer their capital loss harvesting, which we often do in order to offset the large capital gains. Another planning opportunity, which would be effective under the new Biden tax proposals and higher tax rates, but also is effective anytime, is an installment sale. If you're looking at selling real estate or some rental property or perhaps your business, you might want to consider using an installment sale to spread the tax impact of the large sale over a number of years, thereby smoothing out your income and staying within smaller tax brackets in any given year, as opposed to having the full amount of the gain taxed in the year of the sale. And lastly, we'll look at the possible timing and bunching of itemized deductions. This would be something you might want to look at if you are a taxpayer in the 32% tax bracket or above, and you think that we might be limited to that 28% tax benefit if those proposed limitations on itemized deductions pass. You might want to consider pushing itemized deductions into 2021 prior to any enactment in a new tax law. This would include things like prepaying real estate taxes or combining perhaps 2 years of large planned charitable contributions into a single year. You do want to keep in mind, however, that only real estate taxes which have been assessed but are not yet due can be deducted if paid early. For instance, the March installment due in Iowa can be paid prior to year end, but you cannot prepay the installment for the following September and still take that deduction. The last topic I want to talk about are estate planning changes and changes to the estate and gift tax that are on the horizon. These changes are less well defined at this point, but there are several ideas which have either been mentioned by the new administration or perhaps were proposals of the former Obama administration or have been proposed by various members of Congress, such as the 99.8% Act proposed, I believe, in 2020, which was intended to be sure that the top 0.2% of wealthy families paid their fair share of estate tax, while the vast majority of estates under 3.5 million, which comprise the other 99.8% of estates, thereby giving the act its name, would pass tax-free to the beneficiaries. Some of the estate planning changes we see on the horizon include the following: the possible elimination of the step up in basis at death that we receive on assets that have appreciated, or something akin to the Canadian system, whereby there is a gain recognition event at death and tax paid at that time. Something that's going to affect more taxpayers if it actually comes to fruition are the annual gifting exclusion changes. There are two proposals here. The first is a reduction to $10,000 for annual gift exclusion per donee. That's currently set at $15,000. The second is a limitation on the donor of $20,000 per year. Currently, this is unlimited. You can give $15,000 per individual to as many people as you would like. So a planning tip here might be to make any planned annual exclusion gifts early in 2021, as any changes in this area based on historical practices are unlikely to be retroactive. You might just want to try to get those in if you're planning to make them anyway before any changes come to be. Another proposal in the estate area is a decrease in the lifetime gift tax exemption to $1 million, not indexed for inflation. This could result in a big push to make some major gifts before the tax law passes in hopes that it won't be retroactively applied. Right now, both the lifetime exemption and the estate tax exemption are set at $11.7 million approximately. These are identical. There's not a difference between the lifetime and the estate amount. There's also a proposal to decrease the gift and estate tax exemption to $3.5 million or possibly $5 million indexed for inflation. In this situation, I will note it is likely that we'll retain portability, where if the first spouse to die does not use all of their exemption, it is available then for the second spouse in order to further reduce their estate. Some other things on the table are possible estate tax rate increases. Our current estate tax rate is set at 40% once you get past that exemption amount. But in the 99.8% Act we talked about before, the highest proposed rate in that act was 70% for the largest estates in America. And a couple more changes before we wrap up. What might be a change to the valuation rules to eliminate the ability to use minority interest or lack of control discounts for passive assets. That's historically been a very widely used estate planning technique for individuals who have large investment portfolios and who might be subject to the estate tax. And lastly, we're looking at the possible elimination of estate planning techniques such as GRATs, IDGITs, and dynasty trusts. I won't go into a lot of detail here. GRATs and IDGITs are both forms of grantor trust used as estate planning tools. And dynasty trusts came into being when many states eliminated the rule against perpetuities and allowed trust to continue forever, possibly. The proposed changes in this area would limit the duration of a trust to 50 years so that it has to pay out. It would then be subject to estate or gift tax in someone's estate within that 50-year period. We've covered a lot of information today, so I'm going to leave it at that. If you have any questions, I'm certain that Keith or Cody can put you in touch with me, and I'm happy to discuss any of these topics in further detail with you. I appreciate your time and thank you very much.